Is that just, how do I do that? I mean, is that a whole separate process? Or is this, do I go out to somebody like Greg and then he just sources all the different options for me? Or how does that work?
There's both options. There's a lot of brokers that we work with and that others work with, but we also do direct lending to borrowers. Typically, you'll just come in with a pro forma, some information on the property, some information on yourself, and get a quote and an application. And the application is really our summary of terms. At that point, we're going to do all the due diligence, complete the underwriting, do a site inspection, appraisal,
A little bit before that, I mean, in terms of making sure that I'm exploring all the different options that are available to me. Is it, how do I get started? Is it just do I go to Centerline, or is there something different in terms of approaching the topic of government money in terms of going out there for that?
Fannie Mae and Freddie Mac are set up in that Fannie Mae has a DUS lending program, Freddie Mac has a seller servicer program. And so Centerline happens to be both of those. There are competitors that are one of those two, or probably both as well. So for Fannie Mae and Freddie Mac, you're going to go directly to a lender and they can probably provide two quotes. And you can go to more than one lender too. You can go to Centerline and another shop and compare the quotes. But generally, you're going to see similar terms across the board.
Okay, well, maybe Greg, you can help me out as well in terms of mortgage brokerage. Can you tell me, Matt, more about what you're doing for me as a potential investor?
To kind of answer the question you were just asking, let's say you go to Bob Nacklin, you're an investor, maybe you're a new investor, and you want to get a couple of your friends together and you want to buy a building. Depending on how big your collective purse is, you might be getting a 10-unit or 8-unit building, in which case you're not going to be calling Fannie or Freddie. You might be calling Lowell at Intervest or some bank that's going to get you into the property, maybe let you execute some modifications and improvements to the property to get the cash flow up, et cetera, et cetera. On the other hand, if you go to Massey Knakal and you say, well, I want to get a 60 to 100 unit building, well, that's a more typical candidate for the government programs, because only when you've purchased a building that's fully stabilized, fully cash flowing, are you really going to be a good candidate for the either Fannie or Freddie types of lenders. And it's got to have a certain size, a certain critical mass to really pass the underwriting. I think any mortgage broker in this room would agree that it's very intense underwriting, it's a very intense due diligence process, more so than many of the local thrifts and other regional banks are going to expose a borrower to.
And Greg, they can find those properties at www.
So it really depends on how big a property somebody is going to tackle and at what point the property is. Someone might come to, for example, our fund to get financing because they're getting a deal on a building. Maybe somebody defaulted on the loan and the bank is now trying to dispose of the property. Maybe the loan was an $11 million loan. They've written it down to $7 or $8 million. So some lucky person has taken note of this asset that's in play, and they want to just get their hands on what is a vacant asset. A vacant asset is not going to be financed by typical bank. So it's going to require some kind of private lender, maybe our fund, maybe Kennedy Funding, some kind of private lender to just look at the inherent value of the property and say, okay, we're willing to make a loan of X dollars. If it's been written down to $8 million, we'll give you $5 million. You've got to come to the table with $3 million of capital. And you'll get into the property, take ownership of it, go through the work, which is a lot of work to get it fully rented, get it fully stabilized, producing an identifiable, stabilized net operating income. Then it'll be time to leave the private lender and through one means or another finance the property with a bank.
Excellent, thank you. So I'd heard at least 4 or 5 months ago, and maybe it's not true anymore, please correct me if I'm wrong, that commercial deals were no longer just looking at the asset only, but looking at the person themselves. In fact, I think you'd mentioned this one time when we had spoken about how the borrower is coming under more scrutiny, even if the asset itself is cash flowing and should be, something that can be completely isolated in an LLC. That lenders are very conscious of the borrower's ability as a manager of the property. So this is an open question for any of you to comment. Have things changed in the last 3 or 4 months? Is it better? Well,
There's been a change, and the change is driven by the regulators. If you have a cash flowing asset and they don't have personal liability on it, they still want us to look at the person who we're doing business with to understand what their contingent liabilities are. So in the event they have a shortfall in rent, the question is, can the man step to the plate and cover for the month or 2 or 3 or 4 until he gets the space released? On the recourse loans, they want a global look at what the demands are on the man's cash. And the example that I used before is really very important because in prior years, I've done business with people who own garages, and they report nothing. They report absolutely nothing. And yet the example is he's driving a Mercedes, he lives in Great Neck, he's got his 4 kids, they're all in private school. And his wife, if you see her at an affair, she's got beautiful jewelry and it's real. You can't explain that to the regulator, although we do put that in the write-ups. So the inspection of the borrower has become labor intensive, and it's just more difficult. It's doable. I don't think that, I think that the process through our bank, as a bank, is far easier than a government program. We try to make it easier. We do most of our business through brokers. And I work with the broker in order to encourage them to work directly with the client to get the appropriate information from the client, get it to the bank. I like to do my closings within 30 days. The longer a deal sits, the more problems arise, or the chance that the person might actually get cold feet and decide he doesn't want to buy the building. But the interview process, the view of his financial statements has definitely become more intense.
so at what point is it determined in the process that a loan is going to be recourse and non-recourse?
Usually in the very beginning. In my bank, I am the chief lending officer. I'm also the chairman of the loan committee. And basically, I won't bring a loan to committee unless I think it's worthy of going there. My fellow directors know me for a very long time, and a lot of my own credibility goes in the line when I bring something to the table. If the cash flow isn't there, we need some recourse. If you have a commercial property where there's a tremendous amount of lease turnover or rollover within the first year of the loan, and you're making a 5-year loan, you've got to know that the man's got pockets deep enough to handle the reletting, paying the commissions to the broker who relets the space, maybe doing tenant improvements. So we might have to hold back some money for tenant improvements. We also do burn-offs of personal guarantees when a property is stabilized. So there's a lot of flexibility. Our issue is we must make sure we document it carefully why we did what we did and how we did it. And once we get past that, it's very easy. But the determination is basically mine from the very beginning as soon as I see the listing, and I review every single submission to my bank.
Excellent, thank you. So moving a little bit off of the multifamily topic, I'd like to hear a little bit about, this probably only relates to a few of you, about new construction. Is there any new construction going on? And in terms of new construction lending, is that happening? Starting with you, Greg.
Okay. Before I address that, I just want to make one other very critical comment, I think, to anyone here in this room. If I had to describe the single biggest difference from the world we all were living in a year and a half ago to the the real estate universe we're all occupying today, it's leverage. Leverage is entirely different, and I just feel I should have mentioned that earlier. If you're getting started in this business and you're trying to get a few friends together and go out and buy a building or buy another building if you already own some buildings, you're going to have to pony up a lot more equity. I think that's clear across the board here. Even if we're talking about 80% leverage available from Fannie and Freddie for pretty much a fully baked pie, a property that's ready for prime time, you're talking about more pessimistic assumptions typically in the underwriting process, maybe a higher cap rate, maybe higher debt service coverage requirements, et cetera, et cetera, et cetera. So no matter how you slice it,